Hello, everybody. Thanks, Brendan. Thanks to Rocket Dollar. My name is Mike Kavanaugh, and I am the managing member of Regiment. We are a digital investment bank and a family of private hedge funds. So essentially, we find deals that are institutional investment grade, and we invest in it, and then we hand it off to our digital investment bank to allow syndicate investors to join alongside of us. So today's topic is investing in private markets, specifically towards startups. And we're going to cover some of the fundamentals of startup investments. We're not going to talk about the merits and the returns and forward-looking statements. Everything that I'm going to talk about is like from a fundamental educational side of more along how we take investing, our take on investing, which is risk management, discipline, and adaptation, which we covered in the last presentation. So these are just some of the fundamental educational steps that we like to educate investors on to manage risk of investing in startups. So I'll give you a little background on myself, and then we'll take a look at a couple of different ways that investors can invest into startups, and then we'll actually break down the process of an investment. So again, I'm Mike Kavanaugh. This slide looks like my daughter got a hold of. Um, can't read some of the years there, but I basically started in capital markets over 23 years ago as a floor trader. And that's where you learn firsthand that it's not about how much money you make. It's about how many different ways you can lose money, and how you manage that risk. So really got indoctrinated into the industry of trading, which is simply just risk management. Transitioned off the floor into both the trade execution desk position, and then I became a future stock and options broker off of the floor, managed over $100 million in assets in an option overlay strategy, and recently launched Regiment, which I already mentioned is a digital investment bank and fund family. So let's dig into it. The different ways to invest in startups. So when I say vehicles, I'm not talking about Chevys and Fords. I'm talking about the types of investment vehicles, which are actually just pieces of paper drafted by attorneys that are generally fall into some type of exemption from SEC registration as a security. So Reg D is typically what most startups fall under, but lately they've been using different types of term sheets like a safe or a convertible note. But direct investment is when you write a check directly to the startup. There's different means of direct investment, and I'll kind of take a deeper dive into direct investment and angel investment clubs and VC funds and syndicates. But these are the three categories that you can invest in startups. So you can write a check directly to the startup. You can join an angel investment club. Angel investment clubs, I'll drill down on a little bit further, but they typically charge a annual membership for a set period of years, and then you have to commit to subscribing to X amount of startups that come through. So over 3 years, you'll pay $15,000 a year to be part of the club, and you subscribe to investing $250,000 over that 3-year period into the startups that the club approves. Venture capital fund works a little differently. It's a lot more passive. You just write a check and you pay fees. Typical fees in a venture capital fund are 2% management fees annually with a 20% carried interest, or 2 and 20, as they like to say in the business. And then the third is you can syndicate, become a syndicate investor alongside of a venture capital fund. And we'll drill down on that, take a deeper dive on the next couple slides. All right, so direct investment. So just kind of pros and cons. This is where you invest directly to the startup. And this is probably going to be most likely to happen in what I call the 3F round, which is friend, family, fools. The people that write the checks for direct investment. It's usually really early in a startup's life. But one definite positive to that is you're getting in super early at the super riskiest time. So the upside is definitely the most at the 3F phase, where you're direct investment. The only other time I see direct investments outside of the 3F round is if you're talking about an uber high net worth um, angel investor, like a CEO of a major financial firm or a CEO or some family office that has, a trust fund where they direct invest. Most of us aren't in that position. Most of us are, if we're looking at direct investment, would tend to be in the um, early stage of a friends and family round. There's typically no fees involved with that. There's no intermediary. There's no venture capital fund. You're not part of the angel group, so that's definitely a pro when you're coming in that early. Um, Another way to direct invest is crowdfunding. That's equally not expensive, so that's definitely a pro. Um, the crowdfunding lets you diversify, and there's thousands of crowdfunding, well, hundreds, I shouldn't say thousands, hundreds of crowdfunding platforms popping up across the country. And not to name any names, but you typically see the investment sizes, and it like the check sizes are smaller than $1,000, and it's typically geared towards non-accredited investors. Um, so the crowdfunding sites are a benefit for directing your investment to a startup by yourself, but it's typically for the non-accredited. Um, One of the cons of being a direct investor in a startup is you are on your own. So you'll get to see a little bit more about like how venture funds don't just write checks. When you're a direct investor in a startup, typically you're not going to be able to help the company in any way, shape, or form. And a lot of times the companies want you to remain passive because they're just driving the business forward and they don't want active investors that invest directly. And the other part, I always say, insert joke here when you're dealing with lawyers, but at this stage, it's a con that you don't have a lawyer. The lawyer in a startup investment at the very beginning when you're negotiating the term sheet is one of the most important factors of an investment because it really aligns the money going into the startup and the startup CEO and board. It aligns them long term, and really they drill down on just about everything that could go wrong in the investment, and they talk about it rationally, and then basically work towards not letting any of those things go wrong. And they also help negotiate. The trickiest part is always coming to how do you value this startup. So not having a lawyer is actually a con in this point because you don't have somebody to talk through those tricky subjects where you may not know the different nuances of what should be negotiated on a term sheet when you're investing in a startup. So another way to invest is through an angel group or through a venture capital fund. Um, the passiveness is actually a pro here. You can invest your money with an angel group or with a venture capital fund, knowing that the venture capital fund is going to do all the legwork, get their hands dirty, do all the connecting, do all the mentorship, the network connectivity, like everything that goes into helping a startup. A startup is like raising a child. It takes a village. And if you're a direct investor, you're not going to be able to participate in that village. But if you have an angel backed startup or a venture capital backed startup, you're definitely getting the whole group of that network trying to put their thumb on the scale to help grow that. And that's a definite plus to be passive. Um, Angel groups and VC groups are more expensive, which could be viewed as a con, but you're paying them for their time because they're doing all the legwork to um, move the startup forward. Um, I always like to say that when you're in an angel group or a venture capital fund, you want to make sure that the fund understands that they're not just there to write checks, but they're also there to take their years of experience to mentor the startups and then also connect those startups to customers in their networks. So the best example of this that I can find is called A16Z, which is Andreessen Horowitz out of the Bay Area. Mark Andreessen and Ben Horowitz are probably the best in the business when it comes to not just writing a check, but really connecting the startups that they invest with to every potential customer in their network and guiding them through the negotiation process and the scaling growth process. So it's definitely a benefit um, to an investor in an angel group or VC because they take a passive role and they can let the venture funds that know what they're doing basically leverage their networks and experience along with their money to help the startup. One of the downsides of being in an angel or VC group is you're going to be illiquid. So most of the times a venture capital fund, the illiquidity period is going to be about 8 to 10 years, depending on the fund. You won't have the ability to log into your E-Trade account to see how your valuations on your startup VC fund is doing. You get statements from the fund manager through their auditor, but there's no way to check in real time how the startups are doing. So you have to take their word of the valuation and the audit team, which most funds do a great job with. It's just that you can't pull down a real time ticker on how your venture capital or angel investments are doing. So for some people, that drives them nuts because they're used to being able to see real time quotes in their E-Trade account. So that's definitely something you need to consider. I don't know if you want to call it a con, but it's definitely something anything you put in a venture capital fund or an angel group, it has to be money that you can afford to lose, and you should assume that you're going to lose all of it from the beginning because that's the best way to go into a relationship with an angel or venture capital fund. Not that you'd want to lose it, but that's the mindset that we tell people that they should be thinking of when investing in startups and investing in funds that invest in startups. We can make another lawyer joke here, but we'll basically say it's a pro to have lawyers involved based on all the different nuances of what happens when a venture fund or an angel group invests in a startup. You negotiate the term sheet and all the different things that go along with the term sheet, a board seat, an option pool, the valuation, like all the different nuances that a good, experienced professional venture capital or angel startup investing lawyer goes through is definitely a pro. More deals go south with when they start out without attorneys at the term sheet level. So it's definitely a pro to have attorneys involved with the funds. And then the third way that you can do it is by being in a syndicate. So what a syndicate is, we think it's actually the best of both worlds. Um, it's difficult to find venture capital funds and angel groups that allow syndicate sleeves to invest alongside of them, but it gives you the best of both worlds that you don't have to pay the fees to the fund. You have to find a fund that will allow you to syndicate investments. So essentially what they're saying is we'll do all the due diligence and all the legwork on creating the fund, vetting the companies, forming deal memos, making sure that the company matches the investment thesis, getting it approved through the investment policy committee, and then we'll write a check. And then once we write a check, let's say the startup's raising $1 million and the venture capital fund writes a check for 500,000, and then it allows a group of accredited investors that wouldn't normally have a look at a deal. It allows them to syndicate their investment alongside, usually through a special purpose vehicle. They'll create like an LLC where all the investors go into that sleeve, and then that gets allocated to the startup. And then the venture capital fund will manage that SPV just as it manages the money in the funds. So that's just a trend we see picking up nationally, and it's a way that you can invest in startups without having to do the research yourself, but you're going to have to rely on the venture capital fund or angel group that is allowing you to syndicate with them, and you're definitely going to have to trust them and do your due diligence to find out which funds that allow syndicate investors alongside them. So I'm going to kind of dig into the fundamentals of a startup investment from a venture capital fund. The things that need to be considered, and this isn't by any means exhaustive. There's so many things that go into a venture investment. I'm just going to give you highlights and the foundation so you understand some of the process. So, a thesis foundation has to match the startup profile. So, when you start a venture capital fund, the question you have to ask yourself is what makes our fund better, or what is going to give our fund a better shot at investing in startups to make money for our investors? And you have to have that thesis foundation. Um, and that startup you're investing in has to fit the profile of the startup, has to fit the thesis. So I'll get into it in the next slide. And then the due diligence process of, okay, we found a startup that fits our thesis. We like it. Let's see if we can invest in this company. So developing a thesis comes down to a bunch of different things. Where you start are what you know about the emerging tech and business trends. There are funds out there, like I mentioned, Andreessen Horowitz a minute ago. Um, they're known as a generalist fund. They also have a cryptocurrency fund, but their generalist fund, they don't just say, well, we can invest in anything. They have to have somebody on their team, an analyst or a scout that finds a deal that'll get part of the incentive fees to do the due diligence in the deal memo, and then they'll get rewarded by getting a good startup to go through um, from investment to exit. Um, we're at Regiment Alpha is the name of our venture capital fund. We haven't been around as long as Andreessen Horowitz, so we're not as well known. So we didn't think being a generalist fund would be a good idea. So we really drilled down to what our core team knows, and that's financial technologies or fintech. So we just focus on our fund, and we really drill down on the trends, the macro trends, the micro trends, where there are gaps and opportunities, the timing. Is this a new trend? Like if you look at cryptocurrency, it's been around for 10 years. If you start investing in Bitcoin now, are you too late? What things in Bitcoin should you be looking at to invest in? There's a whole bunch of stuff about timing. And then you really want to look at the experience of the team. And once you have all of that, which, it took me the better part of a year to come up with a thesis that would be airtight for an investor so they understood what types of companies we were looking for, and not just going around writing checks to startups and trying to force them into being the next Facebook of the fintech world. So once you've got that thesis developed, the trick is finding the profile company that fits that thesis, where you can start looking at potentially doing due diligence to make an investment. So you have to pick a stage of maturity of the company. Is it pre-seed? That means usually pre-revenue, but they've got a minimum viable product. Seed usually means they've got some profits, revenues, but they don't yet have scalability. And then when you start getting into Series A, that's when you're starting to see growth, where you've got an entrepreneur at the helm. It usually isn't the founder. Very rarely do you see a founding CEO take a company from zero to exit. So you generally start seeing when the institutional growth money starts coming in at the Series A round. That's typically when you see a change in founder. Um, Usually that's discussed before anybody invests at the Series A round. Sometimes people take shots in the pre-seed round or the seed round um, to see if this one could be the unicorn. But usually by the time you get to the Series A round, there's going to be a change in management at the company in some capacity. Another way that you want to gauge a company's profile is revenue traction. Are they staggering each month? Is their revenue transactional or is it recurring? There's a whole bunch of things that go into the profile that have to match the thesis of your investment. Your business model of the startup, are they B2B? Are they B2C? Are they B2B2C? That has to match the thesis. What differentiates this company from one of its competitors? How easy would they be to replicate? You have to explain that to your investors. Like, we won't invest in a company that could be started in less than 6 months with less than $1 million from a competitor. What's their differentiator? What made these guys find something that couldn't be, generally in the tech world, that's going to be a patent. or it's going to be a very complex algorithm that very few people know how to do. Um, that's also got to match the thesis. Um, Scalability, the industry vertical, um, all of these things have to match what you laid out. So on the surface, it sounds like we're trying to find a needle in the haystack, but there's a lot of companies out there finding them. Once you announce that you allocate money to startups and you're very specific, you'd be shocked at how much deal flow comes your way. Um, so these are just the things that you have to think about. I always think it's like a comb, like two combs coming together. The thesis and the profile of the company have to match, and then that gets you a call back. So now the work begins. Once you find out what matches the thesis and the profile of the company, that's when the fun stuff begins. When a junior analyst on the team will start digging in to get their hands dirty, um, and create what we call a deal memo. And the deal memo goes over every aspect that we mentioned in the profile, but now it gets picked apart and really dug into. We want to see the financials alongside of that as well. So if you say that you're doing $250,000 in annual recurring revenue, I want to see your bank statements and your customer contracts. And then we're going to build a spreadsheet out that shows me how much that contract made in March, April, May, June. And we're going to do that with all your contracts. And we're going to match that with your bank statements to make sure the two match. We'll do a background check on all the C-suite executives. We have to review the cap table. And generally, this is an advantage to a VC because we're going to be writing a check from 500 to 750,000, and we're also going to find strategics and we're going to find syndicate investors that help this startup get all the money they need in that round. So they're going to be more willing to give that information to us because if they get through diligence, then there's a reward on the other side of the work that you have to go through um, to get to get a yes, essentially. We'll also have one of our technical experts go through to make sure that the tech that the company says they have is actually real, that it works, that it's not some vaporware that they're creating with pretty spit shine aesthetically pleasing UI, but that the actual tech tests out. So we'll do a full tech dive as well to make sure that that the actual code is up to snuff, so to speak. Once all that's done, then the term sheet is the output of the due diligence process, and um, it's always good to have people around that can help with valuations, whether it's a large accounting firm or somebody in academia. Um, the startup is usually the one that would have to pay for the valuation. Sometimes it's negotiated, but that's where the 409A valuations come in so handy that there's a third party there with an attorney that says, we agree on this valuation. In the valuations that I've sat in, when they are happening, the VC is never really super excited and the company's never really super excited, but they settle. So the last valuation we did to negotiate a term sheet, we came in at 4, they came in at 7, and we said, hey, look, I guess we're at 5.5, and everybody kind of agreed to it. So, but once you slap the table and everybody's high-fiving, then you start off, because you've gone through that process with the startup, that you're on the same page and everybody wasn't 100%, didn't get 100% of what they wanted. But at the end of the day, what that whole process does is it aligns the goal of the company with the goal of the investor for the long term. And then the venture capital fund takes a board seat generally to make sure that goal alignment stays in place. So that's a high level view of investing in startups. And I've got some deal memos, some investor briefs. If people are interested in reading through some of them, I can send them over. And just to give you an idea of, what kind of diligence goes into investing in a startup. A little bit more about Regiment. I already told you we've got an investment platform that serves as an investment bank, and then we've got a family of private hedge funds right now. We're kind of in our beta. We just have the venture capital fund underway. We'll have the other funds, which will be real estate funds, like everything that Rocket Dollar provides as far as different types of private investments. we'll have a private fund that matches real estate. We'll have a fund of funds that allocates to more traditional funds, a private equity fund, an opportunity zone fund, and then we'll have an entertainment opportunistic VC fund as well. That's coming down the pipe. And one thing I'd like to mention is if you do have a Rocket Dollar account, you can come to our platform. If you find an investment on our site that you like, you go through the KYC, AML, and accreditation process. There's a button that says fund this deal directly with your Rocket Dollar account. So there's integration, API integration between Regiment and Rocket Dollar. And if you don't have a Rocket Dollar account, you can go to the site and get one set up. If you use the promo code Rangers, it'll save you $60 off your first year's fee for opening a Rocket Dollar account. And I will stop there. We're going to hold Q&A until the end because we're going to turn it over to Brendan now, and he's going to give you some of the benefits of a self-directed IRA and why Rocket Dollar, how they add value to that process. So I will hand it over to Brendan.
All right, thanks, Mike. So I'm just going to bring up my slides. And to give some context to this is a lot of people say, hey, I love the idea of a Rocket Dollar account. I'm super excited to enter a VC fund, angel group, whatever, but they hit this mental block. How do I actually do it? And sometimes, they get a Rocket Dollar account. They get all the way to the end. We've helped them set up. And then they say, hey, I have my Rocket Dollar account here, and then I have the check, that I'm trying to get to this fund over here. How do I actually get it there? So I'm just going to go through some very quick operations of how the account works and actually how you send money, which is a really innovative part of what's called a checkbook IRA. And these have been around a really long time, an IRA, an LLC, and a bank account, but we've tried to make them a lot cheaper and easier to use. So first, just a little bit about me. I used to work in Chicago with Mike. We were doing some 401k education there. We both got a bit bored of it and said, hey, it's time to do something different. And Mike's obviously been doing a lot of great projects with Regiment here. I decided to move down to Austin, Texas, and join Henry Yoshida and our team down here to try and see how we can get further efficiencies in the self-directed IRA world. Usually not a lot of technology in that world. So what do we offer? Just very quickly, traditional IRA, a Roth IRA, and a solo 401k. All of those are what's called self-directed, which means, and they also all have checkbook control, which means you can put it into an alternative asset like a startup, like a piece of real estate, cryptocurrency, precious metals, the list goes on and on and on and on. A lot of things that just, there's great stocks and bonds custodians out there, TD Ameritrade, Vanguard, Charles Schwab, but they just will not let you usually put a kind of special type of asset in your retirement account. So that helps a lot of our investors save on taxes in places that they normally would not be able to. Okay, so very quickly, just what is the IRA LLC? It's an IRA just like anyone else is used to. Then we create a Colorado LLC for all of our customers. It doesn't matter if you're in another state, except for California. They're a little funky and weird, but for another time. And then we have an LLC bank account. And many people have used, a money market fund when you sell your stocks and, money sits in your money market fund. You go buy a stock or a mutual fund with it, you sell it, it comes back to your account. This is how this bank account really works in a checkbook IRA. So you can send this money out through a check or a wire to, direct investment like we've been talking about, in angel groups and VC fund, or maybe some different deals in a syndication. And that money, that investment is all still inside your IRA. So sometimes there's a big mental gap. Hey, this real estate startup, this finance startup, it's not on the platform, so it's not my IRA. No, it's still technically under that jurisdiction of your LLC. The great part is investors have been building up this LLC model. It's all IRS, proven through case law. And it's been a really handy tool for a lot of people that we've tried to make more accessible. Okay. So some people ask, I have a Rocket Dollar account, just pictured right here. I've gotten it all set up. We rolled our retirement dollars into this account with the Rocket Dollar service team. I'm now ready to make an actual investment. How do I do that? So what do you have available to you? You could do a bank wire. That's pretty much the only outside fee that we charge. We've really tried to eliminate a lot of those. 25 bucks. A lot of investment providers like a VC fund, an angel group, a startup, they prefer a bank wire. It's just that old school method. It's very reliable, very no nonsense. Everyone knows exactly where the money's going, and there's bank institutions can also check in on that wire, make sure it arrived, make sure the money gets into the escrow account or wherever it needs to go. Secondly, you could write an actual check. So a lot of our customers have a checkbook from their Rocket Dollar account, and they can write a check and just give that to the startup, which can be cashed through their bank services. You can do an ACH, funds transfer for no fee. That's up to $100,000. And some people, might ask, why can't I just do that every time rather than the bank wire? That's pretty reliable for smaller transactions of a few $1,000s, maybe like an investment return coming back to you or something. But usually if it's like a very big check, it's kind of a big operation to enter the deal. You want to do the wire just so there's no nonsense, and whoever you're working with is very confident it's arrived on time. It's usually one of the fastest ways to move money. And getting money back. So, as we talked about here, there's these different investments. How does money get back to your bank account? So a very easy one to do is you can do a check scan, just like you would at Chase or any institution in modern banking now, to get it back into your Rocket Dollar account. You can do an incoming wire. So again, there's a small fee for that. But if there's big dollars coming back, you're probably going to want it to be a wire. Just let the institution do that. The $10, it's annoying, but make sure it gets there. And it also, has banking institutions involved to check on that. Again, you could do an ACH, which is great for maybe a smaller investment, a note where someone's paying interest back to you month to month. The check or the ACH is often better. You're avoiding that fee hitting you every single month. Maybe as a startup pays back that note, with a couple percentage points. Okay, and just very quickly, I'll go through the different options that Mike went through. So as Mike said, in a direct investment, you're meeting directly with the co-founders. So you might actually just be delivering their check right to the CEO or to one of the co-founders, or maybe, their lawyer. Not a lot of negotiation, and it's always, there's a lot of negotiation in this one, because you're on your own. And it's very important that your IRA LLC is on all the final paperwork. You are the LLC manager. So this is a really, a lot of people invested, may or may not have invested through an entity. A lot of business owners are very familiar with this process. Hey, it's not my personal money, it's my business's money, and that's who's investing in this project. So when you have an IRA LLC, you're going to want to use that information of the Colorado LLC. Mine is, my name's Brendan Walsh. So mine is B. Walsh, RD, LLC. That's what we default to for a lot of our customers, unless they pay for it, they get a custom LLC name. And then, obviously deliver wire through a check, and you want to keep your bank account handy so that, the startup does need to return investment dollars. Obviously, you can give them that banking information. Another type of direct investment that Mike talked about is crowdfunding. Crowdfunding portals are becoming much more popular. They've sprung up all over. And just as Mike said, we've got that API integration that makes it really easy to work with the Regiment website. So, Regiment isn't crowdfunding, but they do have an online portal that you can interact with. Crowdfunding websites are usually almost exclusively online. You're not going to meet with anyone in person. You might be able to ask some questions by email or in a comment box like on Republic. They're one of our partners down there. And, you might get to interact with the founding team, but you're not ever meeting with this person in person. There's, very set terms. And people at Rocket Dollar can work with anyone that is our partner or is not. as long as they will take your LLC. They just have to know how to register an LLC on their platform. This is pretty simple for some experienced institutions. If you go to a new one that's not familiar with it, if you mention an IRA LLC, they might look like you're an alien, look at you like an alien with 5 heads. They should know what an LLC is. A lot of institutions are not familiar with IRA LLCs. So if you're having trouble, just say, hey, I'm doing an investment from an entity. Keep it simple. And that'll help you get through the sign-up process. And then what you'll do is you'll link your bank account. You've put your LLC information in, so it's clear that your LLC is investing. Again, not your personal name. That's an IRS rule. You have to make sure you don't break and mix up your dollars in between your IRA and your personal dollars. You can try and connect your Rocket Dollar bank on Republic and a lot of these other websites. Our partner bank, Solera, is able to connect directly on the website. If you're having any trouble, you can always do a wire. They tend to like little bigger dollar amounts before they deal with a wire, like maybe $1,000 or more. But they should be able to help you. You can probably email the investor team. And that's something you might need to do. Is if you're having trouble, just email the support or investor teams to help register your entity and make sure everything's being taken care of. A VC fund. So as Mike mentioned, a VC fund, they're doing this all the time. They have full teams that are vetting these startups for you. Depending on how big your investment is, you might meet all the way with the top partners of the fund, the leader of the fund, or you might just be meeting with the investor relations. That's really common for funds that get to a certain size. They have a dedicated investor relations person. And if you're just kind of a standard investor, you're not like a big wig walking in and basically putting a giant investment in the whole fund. They might already have some preset terms that they're used to, but that's up to you and the fund to determine. And again, your LLC name, you are signing as the LLC manager. This is the firm that would probably say, no, this is a wire. That's no ifs and buts or questions about it. This is how we do things. You're delivering a wire. So just understand that, understand what demands they have. Their investor relations probably has a process. And there's many parts of the process to keep things moving quickly for them. So just kind of listen to the investor relations person and they will give, instructions. And as Kavanaugh talked about, in a VC group or a angel group, you might have to do further capital calls. You might have to commit to a startup in the future. So a lot of people say, hey, I invested $70,000 in my Rocket Dollar account. That's great. Did you make sure that over the next year and the next 2 years that you've made a plan to be able to hit all those capital calls? You have to make sure with them that you either have those dollars in your IRA or you have maybe an agreement to work with personally. It's not good to be mixing personal dollars and your IRA dollars. You just have to make sure you don't commit what's called a prohibited transaction where the IRS could get a bit pissed at you. So it's very good to plan ahead if there's going to be these future capital calls and make sure, hey, I have some money in stocks and bonds right now. Next year, I'm going to move a bit more over, and clear it out for these capital calls. Or my real estate property is selling, this next month. So I'll have capital for that. Always plan ahead from the beginning to the end of the investment, especially with a retirement account. Because that money is not as liquid as Mike has talked about often in the beginning. And then a syndicate. This is going to be very similar to a VC fund. They're going to have some really set terms how they do things. A syndicate has probably done the song and dance before. So just follow the process. Obviously you want to do your due diligence, but when operational questions come up, just listen to them, listen to the investor relations. They've done this many times, and they're probably going to have a set process for you to follow. Again, your LLC must be on the docs, or your solo 401k must be on the docs other than your name. But just be aware, because it's a syndication, because there's these different investment sleeves, you could have to do new levels of paperwork each time. It could be really similar, could be almost exactly the same, but just be prepared. Hey, I want to enter this new investment sleeve. I love this new lineup of companies that you're doing. You probably have to sit down with their team. You get that great advantage of the syndication, but you do have to sit down with them, make that call, say, hey, this paperwork, this investment, this is worth it. I'm going to do it again. And again, not as restrictive as the VC fund, but if you end up really loving this company and their syndication, plan ahead. Are they going to have another deal that's maybe more in your wheelhouse coming up in 4 or 5 months? Figure out what their schedule is. Do they have a new deal coming out every single year, or is it a longer time period? And plan your investment planning around that, especially in a retirement account when people might struggle to have as much liquid capital to put in at that time. So just finishing up here, had a nice little gif of our competitors' prices and laundry list of sheets here, but it doesn't always play. Our entry level price is $360 and $15 a month. With the code Regiment or Rangers, that Mike mentioned earlier, you can get $50 off your account opening. And then we also have our gold account, which is $630 a month, and that discount will still apply there for that $50 off the opening, just for some premium features. So anyway, thank you for joining us. We're going to open it up for questions now on startups and startup investing. So feel free to pop into the chat here, and Mike and I would love to help.
Great job, Brendan. Let's see if there's any questions. I don't see any yet.
We'll wait a little bit more here. So there's the chat, and I can feel free to ask anything about startup investing. All right, and we'll also put this up as a recording. So if there's anyone, if you want to see this later, send it to someone else. We're going to keep doing video content with Regiment, and host that in a really awesome part of our website. The website's going to get a nice spruce up coming up in the coming months here.
Somebody just asked if the chat was disabled.
Oh, okay.
They private messaged me.
Okay.
The chat is now available for everyone. There's both Q&A as well as the public chat.
All right. Sorry, we had the public chat there. Should be able to go.
So it looks like we have a question.
Do all the companies, yeah, I'm reading a question here from Michael. Do all the companies need to be based in the USA? So from our perspective of the venture capital fund, my venture capital fund, Regiment Alpha specifically, we can only invest in non-USA companies if we have an expert in that region. So if we find a company from Ireland, we have to have boots on the ground in Ireland that will take a board seat to allow us, and will stay on our staff as an analyst or a junior member for the lifetime of that company. Then we can invest. If we don't have that, we can't invest. I'll let Brendan answer it from Rocket Dollar's perspective.
Yeah, so I'll answer the international one first. And sorry, we got the chat going now. We have a few coming in. We'll get to those. So as far as international companies, with a checkbook IRA, you can invest in international companies. As long as you're following U.S. law and tax law with the IRS, you are free to do so. That's an amazing part of the checkbook IRA, which basically goes with the mentality, hey, our customers take on a bit more thoughts of due diligence and entering the deal, making sure they're aligned, with the IRS rules, but they get a lot of freedom and a lot of ability to go out and grab investments. And then we have what's called a direct IRA. That's where a custodian is actually taking ownership of the shares of a fund or whatever startup you're investing in, and they help approve the deal. Then they will release the funds for you. That helps you get a little bit more due diligence, not on the actual startup itself so much as, hey, this is a fund that exists. They know what they're doing. They're following the rules. This is an allowed investment according to the IRS. The ducks are all in a row here. They're not going to analyze the startup for you, but they'll help make sure that it's okay to invest in. That's fine for funds and established funds. If you have a brand new startup at that friend, family, fool stage that Kevin was talking about, you should probably go with the checkbook IRA. And we had a few questions. Can I invest in traditional assets? And then someone else was asking, can I open a self-directed IRA to invest in Coinbase and other crypto? Yes, you can. That is an answer to yes to both of those questions. So when I put the image here, when these arrows are going out, they can actually go to almost any investment. You can register your LLC at Coinbase. You can also register your LLC at somewhere like TD Ameritrade or Schwab. And that's a nice workaround. We're going to be launching a stocks and bonds tool hopefully soon in the fall here for a little preview. Going to be coming out for customers to invest both traditional assets and then quickly move them into alternative investments like Regiment or something like Coinbase or a startup.
Now the questions are rolling in, and it looks like they're mostly geared towards the self-directed IRA. Okay. I did see one asking about returns. Now I can't find, here it is. What kind of returns are common with startup investing? I have to be careful what I say about returns. I'd be happy to send you, a research report from some of our research partners. It's risky. So if you invest in one startup, the odds of you getting a return are very low if you're direct investing in one startup. The reason venture capital funds are able to make returns is they've basically built teams around trying to identify what not to invest in, so that when the good companies, the ones that look good with the good pedigrees, come through, you only need 1 out of 30 to hit. But I'd be happy to speak more. It's a topic that I can't talk about in a public forum, just returns, but I'd be happy to send you some research.
Yeah, and my comment on it, what I can say is just with the risk level, obviously these are your retirement dollars. So as Mike was mentioning, when you're investing these dollars, you have to be aware that they could go poof, they could be gone. So when you're looking at a retirement account, people think of a similar risk level with their, people all have different risk levels. But if you are getting close where you need some conservative assets, some people will just do a very small bit into a retirement account. They might put into a VC fund, but that is not their whole retirement portfolio. They'll just be frank about the risk here. And, some VC investors will look at 1 of 10 of their companies, understanding 5 might be totally wiped off the map. 1 might hit and, 2 might do okay, 2 or 3, and, 2 will limp along and maybe shut down in a few years. So you just have to really know that, especially when dealing with your retirement accounts. So most of our startup investor customers, this is just one small portion of their IRA, because there are great tax benefits to take advantage of, especially in a Roth IRA if something blows up. But you just have to be realistic about that. Okay, so 2 questions about self-directed IRAs. Is this strictly for self-directed IRAs, or can I use money that's already been taxed? You can obviously invest in cash in many of these different platforms. Sure. So you can use Roth IRA dollars, Willie, if that's your question. And Roth IRA dollars are a really big favorite of both startup and crypto investors because, it's high risk, but they're looking for that pop. That is one of the Yelp investors, is one of the biggest Roth IRAs in America. As they said, hey, very early on, they say, I want my Yelp dollars in a Roth IRA. They set that up right at the beginning. They got lucky with Yelp, and they ended up having one of the biggest Roth accounts. That's like the Mitt Romney type of strategy.
Looks like there's a question here about, can my self-directed IRA invest into a private company that I own, control, or work at?
Yeah, so that's usually a big no-no. There is a great red light, yellow light, green light system that we talk about with Rocket Dollar customers. If you own over 50% of a company, or you are a very key employee, like a CEO, a co-founder, think of someone with a lot of authority. it should almost be a red light, almost always. There are some people that will push it that own 49%. You're kind of walking right up to the IRS's line there, saying, hey, I'm right on the line. But there are people that, do it at 40%. They have 40% ownership in a company, and they know what they're doing, and they've done this many times before, and they invest a lot with their IRA. Between 49% and 11%, that's kind of the yellow light area. You should use caution. You probably need a self-directed lawyer to take a quick look at your documents. We don't have someone internally, but we have someone we refer people to. Because it can be very powerful to invest with your IRA, but you really have to make sure there's no conflicts of interest between your IRA and between your personal leadership. That can be a real big cause for concern. If you own under 10%, or if you're not a key employee, you're usually pretty much in the clear. We've had someone that was a CEO of a company though, and he asked, "Hey, can I invest in my own company that I'm a CEO? I only own like 7%." And we've had some experienced investors just say, "Hey, it's possible under the letter of the law, but you're really still pushing it. You just have such complete control over the company. You should probably step back and say, hey, I love my friend's company. I love this other VC fund. I'm going to put my own cash money into my own company. I'm going to use my IRA for this, my friends or this in my networks company that's doing a great job." Mike, do you want to answer Michelle's question? Then I'll get to.
Yeah, I see that. Michelle asked, why would venture capital funds open up deals to syndicates besides not having enough money to fund deals and or de-risking deals? It's a great question. So we've owned the investment bank. So when we fund a deal, typically a venture capital fund, well, at least with us, we don't take down the whole round. A lot of venture funds will write a check as a lead, and they'll get other VCs that they think would be good strategic partners to invest alongside of them. We own the digital bank that we syndicate through. So our bankers will get paid a success fee. The syndicate wouldn't get charged, and we own an asset management company. So it's more along the lines of taking care of our customers that want a full suite of products where they're not getting charged a fee. We offset all of the success fees at the bank off of our management fee at the venture capital fund. So we're a hybrid firm, and it's not very common to see a firm like ours, but it's not very common for the world to go on a 4-month global pandemic shutdown and $5 trillion in cash. So we're kind of preparing for what's next at Regiment because there's a lot of money on the sidelines. Interest rates in the typical bond markets aren't what they used to be, and the stock market's at near the all-time highs with extended volatility. So we're trying to help our clients understand the marketplace. I've gotten so many calls from so many people, both novice investors up to MBAs from high schools that manage hedge funds that don't know what to do with their cash. And we feel like we have a pretty good idea that we got to roll up our sleeves, get our hands dirty, and invest in these areas that we have expertise in and allow our asset management clients to invest alongside of us. So that's the reason. A little bit of a winded answer, but that's the reason.
Yeah, I'll give a very quick comment on that. It's just there's kind of a unique opportunity right now in that because of COVID, a lot of money pulled back at the initial. I was talking to a friend that works at a fund in San Francisco. It's just a lot of money did pull back from a ton of different areas. Some good deals, some not. Obviously, there's always that risk, but there were a lot of people looking for dollars because their main investors did have to pull back. And just on the questions of, hey, this deal is getting offered to me. I'm not a big investor. Why should it be good for me? Are they just giving me, the good or bad deals or something like that? There's a lot of great funds that are smaller that are still looking to make a name for themselves that might, still need some extra help, some extra networking and capital. And I see in our partners page every day, there's people doing amazing work, but they just don't, maybe they don't have the biggest marketing team. Maybe they've gotten out there as much. So they're still willing to offer some pretty awesome deals, make relationships and network. And I would just say, making relationships and networking with people that are doing super cool work, that'll get you in the know of really cool deals that, if they're doing good work, might become unavailable to you if, didn't have a previous relationship with them or the firm. So Michael had a question. The Rocket Dollar approach seems very similar to a revocable trust. How is this different? So the IRA LLC is it's a retirement tool. So think of it very similar to your traditional IRA or Roth IRA. I'm not immediately super familiar with the revocable trust, but the IRA LLC has a lot more case law than IRAs that use trusts. When it comes to a revocable trust, there's a lot about passing on stuff generationally. And this is not generational transfer. The IRA is basically people in their 30s, 40s, and 50s really trying to invest, use that tax advantage, so that pays off hopefully very big for them in retirement. That would be the startup play, so to speak, to try and take a small IRA, Roth IRA. Is it $5,000 in a crowdfunding site? Is it $50,000? That's just a small portion of your huge, hopefully bigger 401k, and you just put that aside to try and build it up for the future. And I can follow up by email afterwards. Any more questions?
Looks like there's one from Drew.
Okay.
What do startups need to do to get on Rocket Dollar?
Okay. Yeah, so basic level, we have partners that invest through startups that, maybe vet deals, put stuff on their crowdfunding platforms. So the answer is almost anyone that can use a Rocket Dollar account can invest in your startup today, right now, if they feel that they are able to. Rocket Dollar cannot expressly feature deals. We can say, hey, there's some great people at Regiment doing good work. Go talk to them, see what they can do. Go to Republic, go to these WeFunder, go to these different sites that may or may not, depend. You have to really check, is this website, is this partner, are they just throwing the deal in front of me, or are they vetting it for me? So we have a lot of partners that feature startups that people could work with, and then receive some, obviously promotion through there, because they're psyched to show their own deals. Rocket Dollar itself can't expressly put a startup up on our partners page, but we do have startup owners come to us all the time and say, hey, I'm trying to get an extra $1 million. I've already got 20 great investors. We'll just say, hey, usually if you have 20, 30 investors, we usually have at least 3 to 5 people that would love to throw in more dollars with their retirement account. And this helps the startup get, an extra $700,000, maybe an extra $1 million. We've done this many times. I'd be happy to talk about how we help people raise through that manner. Q&A, is there any?
I think we got all of them.
Okay. All right, and we're on the hour, just over the hour here. So really appreciate everyone stopping by. Mike, any last words here?
No, I thought it was great. Brendan, good to see you. And stay tuned. Next month, we'll have another educational Regiment Rocket Dollar, the R&R Education Hour. Thanks,
also,
everybody, for coming.
Thursday. Yeah, Thursdays in the beginning of the afternoon, around just after lunch. So thank you, guys.
Yep. Bye-bye.